Number 4, as a result of the increase in the demand for meal replacement shakes, the current warehouse used by Shake Limited to store the shakes has become too small. On 31 December 2010, the directors decided to relocate to a bigger warehouse in a nearby town. Upon cancellation of the operating lease agreement of the current warehouse, which only expires on 31 December 2011, a penalty of 60% of the outstanding amounts will be payable. The rental of the warehouse currently amounts to 10,000 Rand per month. Payable in arrears, the lease payments for the year ended 31 December 2010 have been paid up to date. The lease contract stipulates that Shake Limited cannot sublet the warehouse. We have identified that this is an onerous contract. Therefore, we will have to provide for either the lower of fulfilling the contract or the penalties. Now, when we talk about fulfilling the contract, this will be the 10,000 Rand per month payable times 12 months, and this will be an amount of 120,000. Or number 2, the 120,000 times 60%, and this will be 72,000. Now let's include this in our deferred tax calculation. Remember, this relates to 20.10. Include that we know that this is a provision. Remember, this is your calculation, guys. Therefore, you can use abbreviations and include your calculation. This will be your 10,000 times 12 times 60%, and this is an amount of 72,000. Brackets 72,000. Okay, so important. What is the tax base? The tax base of a liability will be the carrying amount minus the amount that will be deductible in future. Therefore, the carrying amount is our 72,000 minus the amount that will be deductible in future, the 72,000, as and when this is actually paid. Think about your journal entry. Currently, we debit the expense and we credit our provision. Then, when we actually pay this, we debit our provision and we credit our bank. Therefore, only once we pay this, we will be able to deduct the expense. And our tax base is 0. Our temporary difference is 72,000. And our deferred tax will be 20,160. Now, is this a taxable or deductible temporary difference? Carrying amount of the liability exceeds the tax base. Therefore, this will be a deductible temporary difference. And this will be a deferred tax asset through our profit and loss. Let's refer back to our given information. We can now tick off number 4. Now number 5, guys, they've indicated to us in the last section of this paragraph. The first installment of 30,000 is payable on commencement date of the contract. The first installment of agency fees in respect of contracts which only commences on 1 January 20.11, this is the next year, amounting to 180,000, was also received in advance in the current year and included in the statement of financial position. Therefore, if they have received this in advance, let's think about our journal entry. Debit, our bank, credit, income received in advance. Now we need to transfer this 180,000 to our deferred tax calculation, and this will be revenue received in advance. This is 180,000. Remember your bracket. Okay, so if this is revenue received in advance, remember your tax base of revenue received in advance will be the carrying amount minus the amount that will not be deductible in future. Carrying amount is the 180,000. 180,000 assumed received in cash. Therefore, our tax base will be 0. Our temporary difference will be the 180,000, and our deferred tax will be an amount of 50400. Again, is this a taxable or deductible temporary difference? Carrying amount of the liability exceeds the tax base, therefore this will be a deductible temporary difference, and this is a deferred tax asset. Let's refer back to our given information, and we are now able to tick off number 5. Note number 6, they indicate to us that there is certainty beyond any reasonable doubt that the company will have sufficient taxable profits in future. Why is this important to us? We may recognize deferred tax assets as there will be sufficient taxable profit or loss. Note number 7, they provide us with our tax rate 28%, 80%, and note number 8, we need majority of this to be able to calculate our tax payable outstanding. The only thing that we need to use is this 2,500, which we still have to include as an expense in our current tax calculation. Therefore, in our current tax calculation, we need to include our 2,500 that we need to deduct. Now, this is not a prior period error, guys. This is purely an adjustment of a journal entry that they have not yet recognized as an expense in our accounting profit or loss. We may now complete our deferred tax calculation to be able to include our movement in our temporary difference in our current tax calculation.